Okay, so let's say now you want to invest in stocks. You want to earn a higher return than bonds, and you want a profit and loss oriented return. You don't want an interest income. So before you go investing in stocks, what I would like you to understand is the modern portfolio theory. And within the modern portfolio theory, a very important concept is the capital market line, which we are going to understand using local examples from the UAE. Now, before we can understand the capital market line, we need to first understand what is correlation. And we're going to take the examples of ADNOC on one hand, and let's say ADNOC stock, and on the other hand, we will take Emirates Airline. Emirates Airline. Now, why I'm taking these two examples? Emirates Airline obviously uses oil, right, for flying their plane, and ADNOC produces oil. So let's say if oil price goes to $150 a barrel, so it will be good for ADNOC, right? So let's say you've invested in the ADNOC stock, so the percentage return on your ADNOC stock will be very high, right? You will earn a positive return on ADNOC. So let's say your percentage return is here somewhere, but Emirates return might be lower because, and now it's not necessarily true that Emirates return will be lower. I just want to help you understand a concept that assuming Emirates profit was directly reducing if the oil price was going up, then Emirates return would be lower. In reality, of course, Emirates is being very careful and protecting their profit against oil price going up or down because there are hedging strategies that they use. But for just 1 minute, ignore the hedging strategies and just think that Emirates is going to have a low profit if oil price were to go up, and ADNOC would have a higher profit if oil price were to go up. On the other hand, if oil price were to come down, let's say to $50 a barrel, ADNOC profit would be lower, right? And Emirates profit would be higher because Emirates cost would be lower because they would have to pay less for the oil. So what you have to understand is that when ADNOC return is high, Emirates return is low, and when ADNOC return is low, Emirates return is high. This is what we call a negatively correlated relationship. Now, in reality, of course, it's not exactly perfectly negative correlated that ADNOC is going up and Emirates is coming down and vice versa. But this is just an example to help you understand that in the stock market, there are different sectors. This is a oil producing sector, which is ADNOC. Emirates is a different airline sector, right? So there are a lot of different sectors. We might have cement, we might have steel, we might have sugar, we might have real estate, we might have financial services. So there are a lot of sectors in the stock market which are not necessarily perfectly correlated with each other. They could be having low correlation, they could even be having negative correlation, which is very, very rare, right? But it could be there. Now, why is this important? Why is correlation important? Because it can help you reduce risk through diversification. To understand this, I'm going to show you another chart where I'm going to put risk on the x-axis and return on the y-axis. Now, let's say you put all your money, 100% of your money in ADNOC stock. This is the amount of risk that you're getting, and this is the amount of return that you're getting. Now, the main point over here is you could actually reduce your risk and increase your return if you, let's say, put 50% in ADNOC stock and 50% in Emirates Airlines. Why? Because what's happening here is that Emirates Airline is also a risky company. ADNOC is also a risky company because they are both doing business, and business, the profit can go up and down, and you're buying stocks here. So of course your returns are going to be linked with the profitability of the company. So you're taking a risk in both, and you're adding to one risky asset, you're adding another risky asset, but the magic is that your risk is going down, whereas your return is going up. You're adding another risky asset, so that means your return should go up because it's risk. Higher risk leads to higher return, but in reality your risk is going down because one risk is cancelling the other risk because they have a low correlation. This is the beauty of the modern portfolio theory. Now, should you stop here with 50% in ADNOC and 50% in Emirates Airline? The answer is no. You can add maybe you can do 33% ADNOC, 33% Emirates Airline, 33% let's say Aldar Properties, or let's say Imar Properties, right? Whichever one you like, Imar or Aldar. They are both real estate companies, as I'm sure most of you know, right? Now, if you say, oh, I want to put all my money, if I want to put all my money in real estate, so I'm going to put 100% in Imar Properties or Aldar Properties, well, that's not a very smart thing to do. Why that's not a very smart thing to do? Because look at the slope of this line. Look at the slope of this line. So the amount of risk you are increasing and the amount of return you are getting extra is not that much. See, going from, let's say this is point A to point B, it makes a lot of sense because your risk is reducing and your return is increasing. So that's very good. Going from B to C is also very good because even though your risk is increasing, but your return is increasing quite a lot, right? But going from C to D, putting all your money in one sector might not be very smart because the risk you are increasing is a lot and the return that is increasing is not that much. So that brings me to something called the optimal portfolio. Now, of course, here we talked about just 3 or 4 companies, right? Where we said this is 100% ADNOC, and this one we said is a combination of ADNOC and Emirates Airlines, right? This one we said is a combination of ADNOC plus Emirates Airlines plus, let's say, Aldar, right? Real estate basically. And then this one is like purely 100% Aldar or Imar, which is 100% real estate. Now this one, this C portfolio is what we will call the optimal portfolio. The reason for that is that if you want to go from B to C, the amount of risk and the amount of return are almost at a 45-degree angle. The slope of this line is 45 degrees, which means for every 1 unit increase in risk, you're getting an increase in return, right? But after that, what happens is the risk is increasing a lot and the return is not increasing that much. So this is what is called the optimal portfolio. But it's not that the optimal portfolio has just 3 stocks in it. I gave you the example of just 3 and 4 stocks because I was explaining the concept with a local UAE example. But in theory, when we talk about the modern portfolio theory and the capital market line and the optimal portfolio, these are all risky assets. These are all risky assets which are available in the world. So the theory is that if you take all the risky assets of the world and you check different combinations of those risky assets, this combination, which is the optimal portfolio, is basically that combination which gives you the best risk and return that you can get. Now the question is, what should you do with that optimal portfolio? So let's say this is your optimal portfolio. By the way, this is also called the market portfolio. The market portfolio. Now what you could do is, and let's say this is return on your y-axis, this is risk on your x-axis, and there is something which has 0 risk. What do we call it? This is the risk-free return. This is the risk-free rate that, let's say, the bank is giving you 5%. You're not taking any risk. You put your money in the bank, you're getting 5%. Or you can invest in the optimal portfolio. There is a risk of 10%, but you can earn, let's say, 20% return. Now, what you could do, and let me change colors over here a little bit. What you could do is you could put maybe half your money. Let's say somewhere you're here. You're putting half your money, 50% in the bank, and 50% you're putting in the optimal portfolio of the stock market of all risky assets, right? So you will obviously make little bit more than the risk-free rate, but little bit less than the full. Whether if you were to put 100% of your money in the optimal portfolio, of course you would make this 20% return, right? This is expected return, by the way. It's not guaranteed. But yeah, so expected you will make around 20%. But if you put half your money in the bank half your money in the optimal portfolio, then you will make something less than 20 but more than 5. So this is basically called the capital market line, the CML, that you do portfolio allocation, you allocate your investment along this line, right? You allocate your investment along this line. Here you're putting 100% in the bank, here you're putting 100% in the market portfolio. You could even decide to borrow money from the bank and invest it, continue to invest in the stock market. So this we will call the borrowing portfolio, because you are borrowing and investing. And this part, which is your from here to here, we call it the lending portfolio, because you are actually, when you are saving money in the bank, it's like you're lending money to the bank, because the bank is then buying government bonds and lending money to the government. So this part of the portfolio we call the lending portfolio. Whereas beyond 100%, if you're, let's say, borrowing money and putting 200% in the market, then we call that the borrowing portfolio.